The most dangerous thing about interest rates is not that they go up or down. It's that most people think nothing really changes. Let's start with an uncomfortable truth. When interest rates move, money doesn't just get more expensive. Time itself gets repriced. And that quietly rearranges who wins, who loses, and who even gets to keep playing. This matters right now because rates moved faster in the last few years than at almost any time in modern history. And yet most people still think interest rates only affect mortgages and maybe credit cards. That's the surface story. The real story runs much deeper. Picture the economy like a giant system of promises. Promises to pay later. Promises to grow later. Promises that tomorrow will be richer than today. Interest rates decide how much those promises are worth today. When interest rates are low, the future looks cheap. When rates rise, the future gets expensive. That single shift changes everything. Let's walk through it slowly. Imagine you borrow $100,000. At 2% interest, the cost of waiting is small. You barely feel the time passing. At 7%, time becomes heavy. Every month costs more. Every delay hurts. That part is obvious. What's less obvious is that the same math applies to businesses, governments, markets, and entire countries. Interest rates are not a dial on borrowing. They are a gravity setting for the whole system. When interest rates are low, gravity is light. Risk floats. Mistakes stay in the air longer. Companies borrow easily. Investors chase growth. Governments spend without feeling immediate pain. Even bad ideas can survive for years because money is patient. That's why low-rate worlds feel optimistic. Everyone believes the future will fix today. Now watch what happens when rates rise. Gravity turns back on. Suddenly, money cares about time again. Debts feel heavier. Margins get thinner. Projects that looked fine on paper stop making sense. That startup that promised profits someday just got expensive. That real estate deal that only worked with cheap loans, the math breaks. This is where people get confused. They hear rates went up by 1%. That sounds small. But interest rates don't move the economy linearly. They move it structurally. Here's the hidden mechanism most people miss. Almost everything in modern finance is priced using future cash flows. What you earn later, discounted back to today. Interest rates are the discount. When interest rates are low, future money is worth less right now. That doesn't just slow spending, it rewrites value. A company earning big profits 10 years from now is suddenly worth much less today, even if nothing about the company changed. The business didn't fail, time did. This is why markets can fall even when the economy looks fine. It's not panic, it's math catching up. Now zoom in to daily life. When rates rise, banks tighten quietly, not with announcements, with approvals. Loans take longer, terms get stricter, risk tolerance shrinks. People think banks got greedy. What really happened is that patience disappeared. Higher rates reward waiting, so money waits. And when money waits, the economy slows. Hiring pauses, expansions get delayed, raises get postponed. Not because companies are evil, because the cost of being wrong went up. Now here's the irony. Higher interest rates are supposed to fight inflation, and they do. But they do it by breaking momentum. They don't lower prices gently. They make people stop moving. Less borrowing, less spending, less risk. Inflation cools not because things get cheaper, but because fewer people can afford to play. That's the trade-off no one likes to say out loud. Lower inflation often comes with quieter pain.
and it doesn't hit everyone equally. People with savings earn more. People with debt pay more. Asset owners feel pressure. Cash holders feel relief. Young borrowers struggle. Older lenders finally get paid for waiting. Interest rate changes are not neutral. They shift power. Now let's talk about governments. When interest rates are low, debt feels invisible. Interest payments are manageable. Deficits feel abstract. When rates rise, debt becomes loud. Every percentage point adds billions in interest costs. Money that doesn't build roads, hospitals, or schools, just money paid to time. This is why rate hikes create political stress. Budgets tighten without a single law changing. And because governments are huge borrowers, their pain feeds back into the system. Higher rates mean higher taxes later, or lower spending, or more borrowing at even worse terms. None of those are painless. Now zoom out one more level. Global money flows chase yield. When rates rise in one country, capital moves. Currencies strengthen. Other economies feel pressure. Debt held in foreign currencies gets harder to repay. Emerging markets wobble. Cracks appear far from where the rate decision was made. All from a few words spoken in a press conference. This is why central banks sound cautious, even when they seem confident. They are not adjusting a knob, they are nudging a system already full of leverage, expectations, and promises made under old assumptions. And here's the final uncomfortable truth. Interest rates don't just control inflation, they expose illusions. Illusions about growth, illusions about safety, illusions about how long money can ignore time. When rates were low, many things looked stable that weren't. Rising rates don't create weakness, they reveal it. So when you hear rates might change again, the real question isn't how much they'll move, it's this: which parts of the system were built assuming time would stay cheap forever? And what happens when it doesn't?